Hello and welcome to the 2026 Market Outlook Summit, our final virtual summit of 2025. I'm Shannon Rossick, Director of Content Solutions here at Informa, and I will be your host for today. And in this dynamic 90-minute event, we'll explore three themes that have really dominated headlines this year: how investment strategies are evolving, how legacy planning is shifting in volatile environments, and how AI, especially tools like note takers, are reshaping the advisor workflow. And I want to thank Artha, Trustin, Will, and Zox for making today's summit possible. And I promise you we'll get to the good stuff here shortly, but just have a few housekeeping items to run through to ensure that you get the best experience possible today. To enhance your viewing and listening experience, you can actually customize your webcast interface by moving your windows and dragging around the title bar, or resize them by clicking on the lower right corner. And at the bottom of your screen, you'll actually find multiple application widgets, and clicking on these icons will allow you to open and close the widgets, but don't worry that you will not leave the event. There are slide presentations available for download in the resource list widget, and there are a few other helpful resources in that widget, so I do encourage you all to check those out and download them. If you are looking for CE credit, this webinar has been accepted for 1.5 CE credit hours towards the AEP designation program. Investments in Wealth Institute has accepted this program for 1.5 CE credit hours towards CIMA, CPWA, CIMC, and RMA certifications, and the CFP board CE credit hours for the live broadcast of this event have been applied for and are pending approval, and we'll update everyone on that as soon as we get approved for that. And the instructions for credit submittal are available in that resource list widget. As always, we encourage you to submit questions at any time during the summit. Simply type your question into the Q&A window on the left-hand side of your screen and smash that submit button. We'll address as many as possible throughout the conversation, and the panelists have graciously agreed to follow up post-event should they not be able to get to them during the conversation. And hey, if you're like me and into emojis, we invite you to share your reactions by clicking on the reactions widget located on the toolbar at the bottom of your screen. Final note, just be aware that today's session is being recorded and will be available for on-demand viewing after the event, and you can actually access the recording using the same exact URL you're using today. So now let's quickly talk about the agenda, because unlike our traditional webinars, the Market Outlook Summit, like I said, features 3 dynamic 30-minute panels, each designed to provide actionable insights and education. And our first panel is going to be all about the future trends in investment management. Following that, we'll dive into legacy planning in a volatile market. And we'll wrap up with our final panel, what comes after the AI note taker. So I've talked enough, and without further ado, let's kick off the summit with our first session. I'm pleased to welcome Justin Lowry, President and Chief Investment Officer at Global Beta Advisors, who will speak to leveraging tools to position for the year ahead. So Justin, the floor is yours.
Thanks, Shannon. Appreciate the intro. And yeah, just to provide some context around the affiliation. So Global Beta Advisors, we're a registered investment advisor, and we sponsor our own wealth management platform, Artha. So Artha is our wealth management platform that's, really the sponsor to, today's presentation. So I want to take you first through, a question. So I want to kind of create some levels of engagement first. So when we think about, going into 2026, many of you may have certain convictions on what's going to happen in 2026. What kind of environment are we expected to encounter in 2026? So that's the first question here. What event do you think is going to occur? And then we have a list of options here between recession. Will we see continued persistent inflation? Will we encounter another market correction, much like what we just saw in November and, even more broadly back in April, or do we enter a rate cutting cycle? And then we also give you the options to select, all of them may happen, which is a possibility, or none of them. So allow everyone, just a few moments here to, go ahead and make your selection here, and we'll do the big reveal. All right, let's take a look at the results. Okay, kind of in line with what I expected the answers to look like. For the most part, people see persistent inflation continuing and a market correction. And, obviously the two can go in tandem. If we continue to see persistent inflation, it's likely that we may see a market correction as the economy continues to get too hot. So we've got a follow-up question then too. So given those levels of conviction, what are your plans for positioning in 2026? So, I've listed out some options here. Do you manually update, model portfolios to tactically, move cash up or down? Are you just holding through with your current allocations? Do you use trend following signals such as, Morningstar research or other research applications? Do you outsource to tactical managers, or are you not sure and you haven't thought about it yet? So again, I'll give everyone a few moments to answer the question, and then we'll take a look at the results. Okay, let's take a look. So most of you are making manual updates, for tactical allocations. Fast follower being just kind of a buy and hold through. So those are interesting results, and again, kind of in line with what I expected to see. So we'll tie these answers back as kind of the presentation goes along. So let me get into kind of the first slide deck that I want to go over here, and it relates to the first question that we talked about. When we talk about our market outlook for 2026, I'm not here to say that we're coming in with this high level of conviction that we're going to see a certain environment. It's more of what are the probabilities of certain events that may occur in the coming new year here. So everyone has different convictions. We obviously saw that dispersion in the answers you all provided here. And again, we face challenges in trying to forecast, right? Even the brightest minds in the industry have a really hard time grappling with the idea of having the right environment. And if we knew what was coming, we could perfectly account for it and allocate for it. But that's obviously not the case. So what do we do? How do we prepare? And from our standpoint, it's more of let's map out the probabilities of certain events that may occur, and how do we react to that, and how do we react to that efficiently, for that matter. And so you can kind of see on the chart to the right here, we've got four different types of events that may occur, and what the probabilities of those events are. So recession, the typical 2 quarters of consecutive negative growth in GDP. Right now, according to Bloomberg, there's a 30% chance of a recession, slightly elevated, right, but still more likely than not that would face it. Persistent inflation, which we're defining here as year-over-year year-over-year CPI growth being 3% or higher for at least a year. So are we going to see that 3 handle persist over into 2026? And we put a 33% probability of that based on the contributors in Bloomberg. So there are 75 contributors in Bloomberg. A third of them had CPI growth persisting at 3% or higher for 2026. And then an equity correction, which is a 10% drawdown from recent highs. Ritholtz Wealth Management did a study from 1928 to 2023 looking at all of the periods of equity corrections, and 60% of the calendar years experienced some level of a market correction. So we put equity correction as 60% probability because that's been the historical norm for an equity correction. And quite frankly, if any of these events really occurred, the probability of an equity correction, would definitely go up. And then lastly, a rate cutting cycle. So the way we're defining a rate cut cycle is the Fed cutting, the target Fed funds target rate by 75 basis points over a 6-month period. And based on Fed fund futures, the likelihood of a third rate cut by their June 2026 meeting is about 41%. So we're putting a rate cut cycle, not a rate cut, but a rate cut cycle at 41%. And then the probability of none of these occurring, the probability of at least one of these occurring is close to 90%. So we can have, a fair level of conviction around that one of these events are likely to occur. Which one it's going to be, obviously things can play out. We can judge based on the current levels of probability or our own assumptions, but most likely one of these events are going to occur in 2026. And we kind of want to understand what are the ramifications of those events. So let's kind of dig into each event, individually, and then kind of bring it all together, bring the picture all together here. So again, I want to preface this next slide by saying we're not so much trying to talk about sector rotation here. This is more to exemplify the conversation around what are the impacts that different cycles have, right? So in this case, when we first talk about an economic recession, which Bloomberg is putting a 30% probability to, what does it mean for different asset classes? What does it mean for different sectors of the market? So that way we can kind of glean, what we can expect as far as the dynamics in the market given a particular cycle. So since 1990, there have been 7 recessionary quarters, based on the definition from the previous slide, and not so hard to believe that we're going to see the most economically sectors are going to be hit the hardest. So we've got energy, financials, industrials, and real estate. All of the players that we would expect. We can see kind of some defensive sectors like healthcare and staples perform better. We'll see tech kind of perform a little bit better, as well as investors kind of look for growth areas of the market. And again, this is really supposed to kind of illustrate some of the dichotomy of the market, because investors are generally conditioned to look at the market through the prism of broad-based indexes, right? So it's like, okay, well, the S&P 500 was up or down X basis points, right? And what gets lost in the conversation is, well, what's moving the market? Because as we've especially seen over the past 10 to 15 years, there's distinct winners and losers across just the S&P 500, let alone the rest of the market. So again, this is interesting to see what holds up, what doesn't do well in certain market conditions, and then we can kind of get into, well, how do we solve for that? How do we react to that? So again, like I said, it can be a fragmented market, especially when we see certain cycles, or when we get into certain cycles, whether it's economic or market based. So let's get into kind of the conversation around persistent inflation. What effects does persistent inflation have on different parts of the market? We already kind of reviewed, how different parts of the markets respond to, recessionary periods. What happens when persistent inflation occurs? Which we've been in that cycle more or less for the better part of the past 2 to 3 years. So but how do we kind of think about that going forward, right? So in this case, as we said before, based on the projections of different economists that are contributors to Bloomberg, a third of them believe that we're going to sit at 3% or higher CPI growth for 2026. So that's kind of the probability that we'll put it at. And from 1990, there's been 23 quarters where of persistent inflation, as we talked about in slide 6. And so, as we look at what inflation does to portfolios, normally that's an erosion to growth-oriented stocks. It's an erosion to areas like real estate, and so we kind of see how the market reacts. Obviously, commodity-sensitive sectors like energy are going to benefit from levels of inflation, and just generally defensive sectors like staples and healthcare will obviously respond favorably to persistent inflation. Assuming that persistent inflation may lead to some levels of recession. And so that goes back to our conversation when we started the presentation, where we're thinking about how all four of the different conditions can kind of intersect a little bit, right? So inflation can lead to a recession, can be a part of a recession. Obviously, the markets are going to respond negatively to those kinds of events as well. So a lot of these can be related. Obviously, they can be isolated as well, but it's important to see kind of how each one or how different parts of the market can respond to each one. And so here, we see what happens if persistent inflation continues in the market. So let's take a look at corrections. So when a correction occurs, corrections normally occur in advance of an event, right? The market is seeing a recession on the horizon. It's responding to the possibility that maybe we do see higher levels of inflation. Maybe we see jobless claims go up. Whatever leading indicators kind of hit the market will then trigger a correction. So correction normally will precede, obviously, some of the different macro events that may occur. And that's why it doesn't mean that it's right all the time, right? So, we've seen corrections occur for a variety of different reasons. So again, corrections can occur in isolation, or they can be a part of something larger, like a recession, like the fact that we could get into levels of persistent inflation, or otherwise. So, as we saw from the Ritholtz Wealth Management research report, 60% of the calendar years have some type of correction, right? And so, we can anticipate, more likely than not, we're going to enter a year with correction. And it just so happens in 2025, we saw, kind of two correctionary periods. And so from 1990 through, the third quarter of 2025, the S&P 500 has experienced 43 quarters where we had market corrections, as we talked about, 10% decline from a recent market high. And so, we'll see broad market weakness, obviously, because when a correction happens, it normally impacts the market, more broadly. But as we can expect, more defensive sectors are going to hold up more. And again, I'm using sectors as more of an illustration around how the market can become divided in certain, over certain events. So, in this case, we're seeing utilities and staples and energy hold up in market corrections as investors normally rotate to more defensive areas. So again, market corrections can be a symptom of a larger problem, or they can be in isolation. But what we do know is that in 60% of calendar years, they do occur, and we certainly see a divide in market reaction across different parts of the market. So let's get into a rate cut cycle. So another thing, we've kind of become conditioned to is rate cut cycles being good for growth because it's promoting liquidity into the market. And that is the case, right? Like the idea for the Fed to intervene is so that they're able to stimulate, liquidity into the market and more or less uphold, the broad market. Now, the problem is, and what we've seen with the Fed over the past couple of years is how do they thread that needle? Because it's a double-edged sword. You cut rates in response to deteriorating economic conditions, but if you cut too fast or too much or too late, that can be adverse to the market, right? So timing is everything as it relates to rate cuts. Rate cuts can be good for growth, but they can be they can be symptomatic of a problem in the market, obviously, and that can be negative to risk assets. It can be negative to areas of growth like tech. It can be negative to small cap, right? Because again, if we're talking about deteriorating economic scenarios, that's going to be impactful to the market. So from 1990 through the third quarter of 2025, we've seen 24 rate cut cycles. And again, we're talking about the cycle, not necessarily a rate cut itself. Rate cuts, initially, investors respond very positively. Risk assets normally respond positively to initial rate cuts. They're seen as, helpful to the market conditions. But again, when we get into a rate cutting cycle, it could typically indicate, a symptom of a larger issue that's then adverse to, some different parts of the market. So again, while it increases liquidity, we may see deterioration in economic growth, which can impact, some of the parts of the markets that, that we just discussed. And as we see from the chart here, we see that, again, some of the defensive sectors are respond more positively to rate cut cycles, just again because they intertwine so tightly with deteriorating macroeconomic events. And so again, liquidity is good, support the market's good, but again, if it comes too late or too much too soon, then that's where we can see problems in different areas of the market, as we can see on the chart here. So I wanted to kind of run through some, portfolio simulations to give you an idea of how do we respond to this and how do we respond to it efficiently, right? Because let's kind of tie this back to the initial poll question where we talked about, okay, well, most of you are manually updating, portfolio models in Excel or whatever application you may be using, and to tactically move in and out of cash. But is there a more efficient way of doing this? And is there an efficient way of doing this not to just use cash as the tool for a risk off or risk on type of move here? And so we took our portfolio optimizer and kind of simulated what it would look to optimize the S&P 500 or the Spider 500 for that matter during another '08 recession. So, our portfolio optimizer, we're able to optimize portfolios in different market conditions. And so we can kind of see what would have happened in those markets. And we can be more general too, but I'm just trying to take a very extreme case to give you an idea of what we're looking at here. So we're going into the '08 recession, or, we see a potential recession coming on, or we see, deterioration of financial markets, whatever the indicator is, and we want to rotate into, essentially more of a defensive portfolio. But really what we're trying to do is to understand the behaviors of the positions that we hold and make tactical moves to respond to that. And so here we see, in this case, we basically, get out of the Mag 7, which are the high risk stocks as we can imagine, and get into more defensive stocks here, which is in line with some of the research that we just talked about in the previous slides. And again, this is not to say that this lacks a level of intuition. It's more of how do we efficiently get in and out of different positions to respond to different market events. And so lastly, I wanted to kind of go through the same exercise with the COVID crash, because again, COVID crash, yes, it was a recession, but it was, obviously one of, if not the largest and most swift, market corrections and bear markets that we've seen. And again, similar to what we saw in the optimization for the '08 recession, we're seeing kind of a move out of the risk assets, out of the high risk tech assets, and into more defensive, sectors here. And a lot of you will obviously recognize some of these names that, the optimizer is rotating into. These were, either pharmaceuticals, healthcare, defensive type of stocks that, you would expect to see, going into, this kind of, or, really the pandemic and really that level of, sell-off in the market. So again, it's an interesting way to kind of stress your portfolio and understand what kind of allocations would maybe prevail in extreme market events here. So I am going to kind of take a pause. I know we have only a few minutes left. I do want to try to get to some questions. So Shannon, I'll kind of turn it over to you, and maybe we can get into some Q&A.
Yeah, absolutely. It's a great way to kick off the summit and kind of hear and see what people are thinking of and have top of mind going into the new year. And we did have a couple questions come in, one of them being, how often are corrections wrong in their quote unquote anticipation of an event?
Oh, that's a good question. And unfortunately, I don't have the hard numbers in front of me. But let's take April for an example, right? So that was kind of the tariff crisis, tariff scare. We're starting to obviously see in the numbers that the impacts the tariffs have on economic conditions, but that's one where the market obviously overreacted. And again, it wasn't necessarily that the market was wrong in that scenario; it's that it misjudged kind of the administration as far as how far they were willing to take the tariff crisis. And so, again, we've seen recent examples where market corrections, it was an overcorrection or it was a misassumption, or it could be flat out wrong. But oftentimes it's more of a misassumption or kind of an overcorrection because, again, you do see, especially now, a lot of capitulation in selling, right? So when the market starts to roll over and the headlines become negative, it's just a feast that feeds on itself. And, with the level of algorithmic and electronic trading, things can happen bad fast, but then they can recover pretty fast as well.
Hopefully that quells some fears that if that's the case. Got another one for you. What are your thoughts on rate cuts versus potential manufactured rate cuts to placate administration?
Yeah. So obviously we're seeing that in the headlines now where, there could be a changing of the guard at the Fed. That's why I talk about, when we got into rate cuts, the discussion around rate cuts, we talked about a cycle and not necessarily rate cuts in isolation, because you're right, rate cuts in a cycle can be problematic because whether the agenda is politically driven or the Fed was just flat out wrong or late, it doesn't really matter what the reasoning is. If the Fed has to catch up or if the Fed has to rapidly cut rates, that's going to be be bad for risk assets. It's going to be bad for equity markets. But we've seen that you're able to rotate into the right areas of the market to try to prevail through that situation, because it doesn't mean you throw the baby out with the bathwater. As we saw in the previous slides, there's going to be pockets of the market that prevail. It's just a matter of being able to position yourself the right way.
And I have one for you because I am just curious. How do you see advisors balancing client expectations for downside protection with the need to stay invested in secular trends like technology and healthcare even?
Oh, that's a great question, and it's a question that we've dealt with advisors. In fact, I had a conversation last week, generally about that, right? So, how do we stay invested? How do we position ourselves in the trends of the market? Where things are going, but stay relatively defensive. And again, somewhat of a shameless plug here, but we within our platform, we're able to kind of manage around that, where you can have different securities be included in your portfolio while also managing risk. And what do I mean by that? It's a parameter that we actually have built into our platform to control levels of client suitability, but also try to include some of those risk assets. So I'll give you a general example, right? I want my client to be in a moderate portfolio, but I want to hold NVIDIA, I want to hold Apple. And you can do that. And you can do that within our application. And it's a lot more efficient to try to do it that way than to try to piece together a portfolio manually and try to judge the effects of that portfolio. It's kind of like, let technology do some of the heavy lifting for you, so that, like you said, you can stay invested. You can stay invested in things that you think have levels of growth, but, not taking your portfolio too far.
Absolutely. Well, I know we are coming to the close here of this session. I appreciate you starting out the summit very strong. But just before we wrap up, maybe Justin, if you could just give kind of a final takeaway as folks are going into 2026, what they should be focused on, and then just give a quick shout out where they can find out more about you and what you're working on.
Yeah, no, and our general thought is, be cautiously aggressive, I guess, is the best way to do it. It was great that you mentioned that, or that you asked that question there, Shannon. It's, try to, the way that we're looking at it is we're trying to, again, curb levels of risk, but also try to stay on the offensive too. You don't have to be completely defensive. you do have to be cognizant of the probability of different events occurring. But again, it's all a matter of being able to efficiently make those proper rotations, and again, being reactive. And it's not to say that advisors have to be active portfolio managers and buried in their computers, but they can better tailor their portfolios, and they can do it more efficiently. And look, if anyone wants to reach out with questions or have those conversations, again, you can reach out to our support email here, or reach us at hello, or look at us at helloartha.com. And then I know you guys will be providing my contact information as well.
Awesome. Well, Justin, appreciate the presentation and your time today, but we do have to keep it moving with our next panel. So I am actually thrilled. This is a nice segue. We were just talking about, recession, inflation, things like that. So we're actually going to be diving into legacy planning in a volatile market. So excited to introduce my colleague, Davis Janowski, who's going to have a dynamic conversation with Andreas Mazabel of Trust and Will. So welcome, gentlemen. Take it away.
Thanks, Shannon. Yeah, as Shannon just said, this session we're going to explore how advisors can take uncertainty into opportunity through proactive estate strategies, digital estate tools, and year-end planning techniques designed to preserve and protect multi-generational wealth. So, Andreas, tell me, why are we talking about legacy planning in a market volatility session?
Yeah, I love the question, Davis. Thanks so much for the time. Looking forward to our conversation. There's one thing that we know for sure. The market's going to go up. The market's going to go down. If we all had a crystal ball on when that actually happens, we would probably wouldn't be here. So what we do know and have learned more and more about from consumers is what consumers are looking for around peace of mind from working with a financial advisor. And in today's conversation, what I want to walk you through is how some of our research is actually very telling on the impact that you as a financial advisor can actually have on your client's peace of mind, regardless of if the market's up or down. But we recently did some research that I want to dive deeper into on how is this affecting your clients or even your prospects that don't have any estate planning in place. What do they think about? Is their anxiety levels higher, lower? And also, who is really doing estate planning? So when you look at your book of business, your prospects, you can think of newly married couple, and in the back of your mind, based on the research, have they thought about estate planning compared to someone that's retiring or that already has children? So really excited to dive into the conversation. And then Davis, can you help me thumbs up that you can see my screen?
Amazing. Your screen. Oh, not yet. Nope.
No.
I can see the slides, but not your screen.
I can see, here we go.
That share screen button up there in this top center.
Great. How about now?
Yes.
Perfect.
Got it.
Okay, so let's first and foremost dive deeper into how are your clients, your prospects that we recently surveyed thinking about volatility? So first and foremost, inflation is very top of mind for Americans nationwide. So 4 in 5 Americans has essentially told us that inflation has made it harder for them to achieve their goals. Obviously, many of them are very likely working with you to help alleviate some of those fears, to help achieve some of those goals. And then this second part of our study in 2025 that we completed is that nearly half of Americans say that they are more concerned about their financial future now than they were last year. So rates continue to be high. The market, the unknown, the unpredictable, right? Obviously the market is never going to be predictable. But what the study is telling us is that your clients and your prospects today are more concerned about achieving their financial future and their goals than they were last year. So when we look at, this survey is how much harder has inflation made it for you to achieve your goals? Well, only 6% said not harder at all. 15% not much harder, but these last two, 43% said somewhat harder, and then 35% of them said much harder. So this hopefully gives you some insight onto this survey that we did earlier this year. And this is a fresh survey that we did last quarter, and it's called our Peace of Mind survey. And essentially is how estate planning shapes mental health in America. So to give you context, 1,000 US adults were surveyed, 500 have an estate plan, 500 have no estate plan. So we're gonna call the 500 who have an estate plan the planners, and the 500 with that one the non-planners. And let's dive deeper into how this is actually affecting literally their peace of mind, their anxiety levels around protecting their family, protecting their assets as well. So the first key one is 82% of planners feel at peace about their affairs versus 50% of non-planners. So that's a huge discrepancy. And I'm actually putting myself, I have an estate plan, but we recently had a child, and I work at Trust and Will, and I have not updated my estate plan. And I'm not kidding you. I keep thinking about it, like, when I sit down with my wife, we're gonna get it done, we're gonna get the notarization done. So I'm putting myself today in the non-planner, and I'll tell you, it's something I keep thinking about. Because now I look at Mateo and I'm like, have to get that stuff updated and make sure it's notarized. So these are likely some of the feelings that your clients are feeling today. So if you think of clients that have recently maybe moved states, bought a house, bought a business, got married for the first time, these are likely some of the things that they're feeling, right? So the 50% saying they don't feel at peace of mind. Non-planners are 5 times more likely to feel anxious every day. And Lily, these are real stats from real people that we did recently. And then planners are 4 times less likely to say stress disrupts their relaxation. And the last one here to show you is that 23% of non-planners said they're likely to start an estate plan in the next 6 months. So they're feeling anxious. A quarter of them told us, I want to remove that anxiety, and I want to start my estate plan in the next 6 months. And this is where we've seen a huge increase in advisors influencing their clients on providing the education on what is an estate plan, what is an executor, guiding them through what does it mean if something happens and you don't have an estate plan in place. And from there, the accountability piece. This is also a big reason why your clients are hiring you as their advisor. They know that they want to have their kids go to a good college, retire comfortably, but they need your help. They need your help holding them accountable on that savings plan, on the 401k contributions that they're making. And this is where they're asking for your help around making sure that their estate plan is set up. And if it's set up, that it's been reviewed in the last few years, if they've made life changes around moving states, having kids, whatever the scenario might be.
Yeah, I can agree with that. I wrestled with that. I'm a bit older than you are, Andres, and I have a daughter who's now 20. It took years before my wife and I got our act together to talk to our advisor and estate attorney and actually got it done. And these stats that you have here bear, I think, some discussion. It's kind of eye-opening to me.
Absolutely. And what we continue to hear when an advisor helps their clients with the education, with that accountability, literally it's all about what the survey was about, which is that peace of mind. That client coming back to you and saying, gosh, Andres, I feel so much better that we got this done. Thank you for guiding us through it. Thank you for educating us on it. And then most of the time, and I have a slide to show you as well on this, the impact of your peers, of your competitors who are actively and proactively integrating this into their conversations with their clients, it's helping you get to know your clients better, help build connections with next gen, helping you get referrals, and I'll show some of those stats. Okay, so you might be wondering, help me better understand who is the planner and who is the non-planner that we talked about in the previous slide. So we've done a lot of surveys and studies on why people create an estate plan? What is that triggering point? A lot of times, and most of the times, it has to do with having a child. So 42% of married couples lack of estate plan. So the good news, close to 60% of those married couples do have an estate plan. But think of your clients again, maybe they've been married for years, they recently got married in the last 2 years, but this is a huge demographic that needs your help and your assistance in education. A lot of folks, believe it or not, don't know that if I have a kid and they're under the age of 18, what would happen if there's no guardian set up or you haven't named a guardian yet? So walking them through, educating them on that. And again, it really opens up the conversation into who are those like really important people that your clients trust. Is it an aunt? Is it a close family friend? Whatever the case might be. The second one here is only 23% of parents have documented guardianship. So this is what I literally just talked about. And if you bring this up to your clients, I promise you, they're going to feel a lot of gratitude about the education that you provided. And hopefully with some accountability, they're going to go home, they're going to talk to their spouse and say, oh my gosh, like we just learned this from our advisor. We have 2 kids under the age of 18. We have no guardianship in place. We now know what would happen if something happens and we don't have the guardianship in place. So really providing those examples, that education is a very, very big part of it as well. And then lastly, or last two, only 10% of married clients creates a plan within 2 years of marriage. Intent is high among engaged couples, but execution is low. Probably no surprise to you. Clients get married, they have a million things that they think about. They're like, yes, we'll get to this, and then they don't. So again, this is where we personally at Trust and Will are providing advisors with a ton of visibility, where you can actually see, has my client updated the estate plan since they got married? When's the last time they made that update? So having that visibility is going to be huge for you all, because again, the intent is high. If you think of recent conversations, maybe in the last few quarters that you've had with clients around estate planning, most of your clients are coming back and saying, I don't want to talk about estate planning. I don't want to protect my family. Most of the time it's, gosh, yes, I've been meaning to get to this. I'm so glad that you brought it up. And I'm so glad that we're talking about this, because it's been in the back of our mind. And then obviously, if you look at your single clients, many say they have no intention to create a plan. So, they might not be thinking about, wait, I don't have a family. And again, that is a very big misconception, I think, historically, that we've seen around estate planning, which is truly that, someone might come in and say, I am not a millionaire yet. I'm not married yet. I don't have kids. I don't need any estate planning yet. So again, this is where we're seeing a lot of really valuable conversations, even for your clients that are not married, that are single, on educating them on this. We actually have many of our partners that even for their clients' children, when they turn 18, when they go off to college, they will essentially say, hey, clients, I love, as your kid goes off to college, for us to do a quick education on a power of attorney, a HIP authorization, all those documents that we as parents don't think about until our kids are of legal age. And what we're seeing here is it's all value add. Parents are going to come back and say, oh my gosh, I didn't even know about the HIP authorization or the power of attorney now that my kid is going off to college. So hopefully, I think to recap this slide is there's a big opportunity across various different clients. Are they married? Are they single? The big takeaway is driving that education is what is going to help your clients in taking the next step. And again, you can see here, they have many clients, prospects, have that high intent to get it done. And this is where you come in. And I'm sure we don't have a slide on this today, but I'm sure you've seen the various different studies, not done by us, but by other third parties, on how estate planning is actually one of the biggest services that clients want in working with an advisor. They know that you're going to help them with volatility, with investment management. You're going to talk about insurance, right? So as more and more advisors are doing more financial planning, is really think about how effectively are you integrating estate planning into those conversations, either in your financial planning, in your onboarding of new clients, and then obviously more importantly in your ongoing reviews and conversations with your clients. Because what we're seeing is, if everything estate planning is very life events based. So when you talk to an attorney, when you engage with Trust and Will or other platforms, most of the time it's you're creating and or updating an estate plan, usually around a life event. So the more that you can plug in these conversations with your clients, not just once, but ongoing, because your clients most of the time are calling you and telling you, Andreas, we got a job offer, we're going to move states, or wanted to share good news. My wife is pregnant, we're having our second child. So those are all like such key moments that you've earned your clients' trust. And I think it's all a matter of how do you leverage and use that information that they've shared with you to help really, decrease some of that anxiety that they might be having around those major life stages when it comes to that.
I can add there too that, I think just the fact that you guys can break it down into steps and it doesn't look like such a monumental task for especially younger, maybe folks in their first or early in their career, that looming over them and then hearing from their advisor, well, it's just these, finite steps you have to take can be a big help. I know that was the case for my wife and I when we finally get it done.
Yeah, thanks for bringing that up. That's usually when clients are educated about estate planning, a lot of the consistent feedback we've heard is, that's it, right? Like when you kind of walk them through, here's the process, here are the decisions. A lot of the times they just want your help in what is an executor, what is a beneficiary, right? So really providing that education. And Davis, to your point, like they'll come back and say, oh my gosh, okay, well, these are important decisions. We'll discuss with spouse, and we now know the steps that I need to take on creating this estate plan. But to your point, a lot of time it's that feedback that comes back and says, okay, that actually wasn't as bad or complicated as we had originally thought. And that's one key point I would make sure you walk away from is like there's been a lot of misconceptions around estate planning, on who needs estate planning, on why estate planning, right? And again, the bigger theme that we've seen is people think they're not ready for an estate plan because they don't have millions of dollars. So they think estate planning is for the high net worth. So it obviously explains a lot of the stats that we've shown over the last few slides on the impact that this is having to, potentially some of your clients. We obviously saw the stats around the anxiety, and it's literally in the back of people's minds of I don't have that done, but I heard about it. I saw a commercial. My neighbor talked about it. So let's talk a little bit about how is like estate planning driving growth for your peers, or I would probably say even competitors as well. This is our 2025 annual financial advisor study. And we've always known that estate planning is all about providing clients peace of mind. So a lot of what we've covered so far in helping alleviates that anxiety, in helping provide that peace of mind. But we started to hear from advisors who work with us, and they're coming back and saying, I keep getting referrals. I keep uncovering assets I didn't know about. And it makes sense because think about when today, if you're not working with a platform like Trust and Will, you very likely have attorneys that you refer clients to. And by the way, we don't replace those relationships. We essentially complement and give you guys another option for you to refer your clients. But what we're seeing with a modern estate planning platform like Trust and Will is the visibility that you will have through our platform. And I'm going to give you the context to go into the stats. But in short, I spent over a decade in private banking with JP Morgan. We would refer clients to an attorney. And a lot of times the theme is we would see that client back 6 months later, and they would come back and say, I know what you're going to ask. I haven't done the estate plan. I haven't even called the attorney. But it makes sense because also you don't have that visibility. Has my client reached out? Have they started the process? Can I see the document? So the big thing that we're seeing, in addition to being a much more affordable option, is the visibility and control that you as an advisor have via trust and will. So meaning I can see as my client started, I can see who's named in the estate plan, all the key people, all the assets. And we're literally having advisors and partners that come back and say, we use that information and actually do a family planning meeting. So let's talk deeper about who's this executor, who's this power of attorney, your children, what type of value can you add now that you've uncovered additional information about your clients? And also keep in mind, if you want to get very personal about their values, you want to dive deeper into what charities did they choose and how do you open up a conversation about, tell me about that charity. Like, how did you come to find that, or what's the mission behind it, et cetera? And again, what this is really turning out to is 70% of Americans say estate planning should be included in the advisory experience. And clients feel so strongly about this that 40% told us in a study that they would switch to an advisor that offers estate planning. And for folks that haven't worked with us, you might be thinking, well, how can I offer estate planning? I'm not an attorney. I'm not providing legal advice. Totally get it. Via our platform, it is not your role to provide legal advice, to draft documents, but it's all about the education, the accountability, and giving them access to a platform like us for them to get it done. And then the 4 key points I really want to highlight here is 59% of advisors report improved client satisfaction. So I want you to think about the phone call to your client that says, hey, clients, I'd love to schedule a review, look at our performance so far, which is really important. Don't get me wrong. Obviously, that's a big reason why they're hiring you. But also imagine a world where you give your client a call and say, hey, I saw that the estate plan hasn't been updated since you had Mateo 4 months ago. I'm calling myself out here. And from there, the peace of mind that would provide to your client that says, gosh, Andres is thinking about me and my kid, not just my investments, not my assets, but making sure that I make that update. So think about what that really means for your clients in making sure that their estate plan's up to date, or as you saw in some of the stats, they also maybe don't have one at all that they've been thinking about. Retention. How does this impact retention? So 56% of advisors report increase in clients' retention. So this is all around, again, engaging more with your clients and being more present and proactive when your client has a major life event. So you all do an amazing job in helping plan, again, for retirement, for buying that first house, all those like really important life milestones. So this is, again, just being there for your clients, and it's going to increase that retention. And then for folks on the call today that might be looking at 2026 and say, how can I grow my business? And less of buying leads and doing more ads, et cetera. Obviously, I'm sure you have a growth strategy there. But here's the thing. Many of your peers are growing their business by leveraging estate planning with your existing clients. So what we are now seeing, and we actually have a few case studies on this. One is actually, I'll share this quickly. It's an LPL advisor, LPL affiliated advisor, who now talks about trust and will as literally #talk trigger. And I'll be high level here. They integrate estate planning early into the planning process. Clients complete the process, and here's the magic. That client, believe it or not, they go to a soccer practice, a kid's whatever it might be, and they talk to their friends and say, we finally got our estate plan in place. And that person, and we talked about the anxiety and how people are thinking about this, believe it or not, in the back of their mind, they say, oh my gosh, like I've been meaning to get this done. I've been talking about it with my spouse. Who helped you with it? And that's where that natural referral is coming into play. And then the second one is the 44% of advisors saw AUM growth from existing clients, which is huge. So this reminds me of my days at JP Morgan. What percent of, wallet share, they used to call it back in the day, are you managing for your clients? And a lot of times we get so focused on the next clients, prospecting, those leads that are coming in. But a lot of times it's how can we go deeper with the planning that we have with our clients? And this is where advisors have more visibility than ever before around, going deeper into a client created the estate plan. You now have a full report of all the assets. Do they have life insurance? Are there any assets in the estate plan that you maybe didn't uncover at the very beginning? So I'll pause here and, well, actually, let me go deep into this one because not deep, but high level. This is one that we a lot of times forget. Like there's so many life events. There's 27 million annual life events. And again, you heard me talk about it a few times. Estate planning is all life events. So if you look at 2 million people got married in 2022, 3.65 million became parents in 2024. More than 500,000 people got divorced. That's a big, big deal around the estate planning piece. And home ownership, 5 million homes were sold in 2024. So really think about like relocation, retirement, like all these are such important key milestones that we want to make sure that you as an advisors have the visibility to provide that value. So what I would end as we're close to the end here is end of year. Obviously, we're early December. We're going into the holidays, but when you really think about early Q1, your 2026 strategy is how can you really integrate estate planning into your practice? So 78% of estate planners feel optimistic about their personal life in the year end, compared to the 54% of the non-planners that we talked about in the first slide. So this is a time where clients are starting to review, with your help, review insurance, taxes, setting financial goals. So it's really a matter of like they're in the mindset of like, what do we accomplish this year? What do we want to accomplish next year? And I promise you, start to have these conversations with your clients around, if you're not having them yet, do you have an estate plan? And if not, like providing that education, that accountability, because again, it's a big part of what your clients and prospects are looking for.
I can attest to that from my own experience, Andreas, that my wife and I getting our estate plan created was not a terribly pleasant experience. And we had gotten a referral from an advisor. And frankly, we liked the advisor a lot more than we liked the estate attorney. Now, this is just my own experience, but
yeah,
I think advisors have a real opportunity, because part of what was uncomfortable was simply that the attorney themselves, who we dealt with a good bit, looked at us. And my wife, she's a fellow journalist and she has lots of questions. The attorney really didn't want to spend the time to answer those questions. So to me, advisors have a very natural opportunity here, because most of them really like to work with clients, talk to clients, and plan. So I really do believe that whether it's Trust and Will or one of the competitors, that the technology has improved such that it's a great opportunity.
Absolutely. And historically, to add to your personal experience, it's been kind of intimidating. You don't know how much it's going to cost. What is the process going to go? How is it going to be go with the attorney? So it's not, again, we have a national attorney network. Over 350 national attorneys are part of our network. So we love attorneys and they're a huge part of our business model. But we just, to your point, strongly believe that with technology, we've made it a little bit easier for many of your clients who don't have an estate plan set up.
Well, we've got just a minute left, and a few questions did come in, but there is one here that I think bears maybe touching on if you can, and that's someone asks, what does the client side of working with Trust and Will look like? I don't know if you can touch on that.
That's a great question. So essentially, it's a way that advisors can invite a client goes through, they set up an account, they can decide if they want to schedule this or do this with an attorney or do it on their own. And it's really a questionnaire as it kind of walks them through. But again, we do have an attorney support in which your clients can feel guided as they go through that experience with the attorney. So here's a QR code, schedule a demo. And I know, John, you have a question here on Osaic in approval. We actually are hints, have an announcement going out next week that we are getting approved with Osaic. So more to come there. But with that said, I want to be respectful of our time and really appreciate being here today.
Great. Filled with information. Thank you very much, Andres. I'm going to patch the baton back to Shannon now.
All right, we've covered a lot of ground so far, so thank you both, Davis and Andreas, for another great presentation. But we actually have come to our final session. I do appreciate all of you for sticking with us. So to round us out, I have the pleasure of welcoming Mark Gilbert, CEO and co-founder of Zox, to round out the summit with a discussion around what comes after the AI note taker. Like I said, we are covering a lot of topics today. Very excited for this one. So Mark, want to welcome you here. I think we're just trying to get the presentation off the screen here, and we'll loop you in.
Awesome.
All right. Well, Andreas, if you're still there, if you wouldn't mind just exiting out or unsharing your screen so we can see Mark's lovely face here. All right. While they do that, just want to kind of set the scene for this conversation as I'll be moderating the session with Mark. And with 2026 just around the corner, the role of AI in advisor-client conversations, as we know, is evolving. So we've moved beyond just capturing notes, and now it's all about how AI drives action and processes and advisor performance and growth. So the way we're going to frame this conversation is I'm going to make Mark go through a 3-part series with me, talk about where we are today, what's possible tomorrow, and how advisors and RIAs really should prepare for 2026 and beyond. But before we even get into that, Mark, if you wouldn't mind, give just a brief overview about you and Zox and what you're working on over there.
Yeah, thanks, Shannon. Really appreciate the time. So I'm Mark Gilbert. I'm the co-founder and the CEO of Zox. We started the company a little over 3.5 years ago and launched early last year. And we're essentially an AI assistant for advisors. So we're focused purely on financial services. As we'll talk about today, we really started around kind of taking notes and the note taker aspects for advisors working with their clients, meeting preparation, all that. And then, from that, have expanded out to kind of do more and more to really help the advisors. So very excited to be here.
Awesome. Well, thank you for that context. And that's perfect segue actually into my first question for you, because as we know, many firms have adopted the AI note takers. 2025 really seemed like the year of the adoption around it. So what are you seeing in the field right now in terms of adoption, utility and limitations? What has that evolution looked like?
Yeah, so as you mentioned, last year we saw a huge amount of adoption. We've been growing extremely quickly. And I think, a lot of people, probably a year and a half ago, had probably never even thought of or heard of a note taker, especially a financial services one. And, since then, we've been growing like crazy. I would say everyone now who is using, we really see kind of 2 groups of users. There's the ones who are I would say, getting going, and they're using really a system like Zox and AI to help do things like prepare for a meeting, capture all the data from the meeting. It allows them to focus on their clients very, kind of closely without having to stop and pause and take notes, and then get all the data they want, really into the CRM system. And it essentially replaces what they were doing manually, often with either like pen and paper or iPads or, typing notes. So I would say that's the first block. And pretty much everyone starts there, right? They start off, they just want to get a quick win. They can get going with that super quickly. Like we onboard people all the time, literally in 5 or 10 minute sessions, and they can start using it that day. The next phase for us, and we started to see quite a lot of our users do this, I would say, over the last 3 to 4 months, is they're starting to connect other systems as well, right? So if you think of the CRM and you think of like, as an advisor, I need to type in these notes, and I often go there to understand what's going on with my clients. There's a whole bunch of other things that you want to do as well, both after the meeting And then even when you prepare for a meeting, some of the data you want to get isn't necessarily in the CRM system. It's going to be in the planning system, going to be in the portfolio management system and things like that. So I would say the people that are a little farther along or maybe a bit more comfortable, what they've done is they've attached, Zox to a planning system. So like an eMoney or Right Capital, these types of things. And the value of that is, first of all, that we can actually fill out a plan for them. So like the AI systems can now analyze literally hundreds of data points in eMoney. If there's no client there, we can create a client, create a plan for them. If there is a client, we can actually go and analyze everything and say what needs to update. So if you think of all of the work that either you're doing or often your associate or paraplanner may be doing, of going in and frankly updating all the detailed fields in eMoney, you can now literally just do that with the click of a button. And that works for a number of systems. Essentially, anytime you need to update, whether that's account information in the CRM, like contact information, household information, the plan, any of those types of things. So that's a big piece. And then the other thing is when they connect these systems, that also gives us the ability to use that information to help do more things for them. So as an example, if they connect the planning system, we can now see the plans they have for that client. So when they go in to prepare for that meeting, we can actually give them the overview of what's the plan, what's in it. If they connect a system like Calistaplan, more of a tax planning, they can actually get tax information from that directly in a meeting prep. And we can even do things like use the information in that tax return to help fill out forms and things like that for them. And so what it's doing is it's kind of in the second phase. We started to kind of pull from a lot of different data sources using AI, and then using those different data sources to start filling in things, right? And those typically are financial plans and really forms for intaking, if they're doing insurance, maybe there's insurance applications in there and things like that. And so that's been the next big phase for us.
It's funny because just a couple of years ago, I remember saying on stage during a panel debate, man, how nice will it be when these technologies can speak to each other, plug in, overlay, whatever it may be, and you can just instantaneously take information like this and drop it into your CRM and create processes and workflows. And now we're here. So it's just a testament to how quickly we're moving. I think people forget that just a few years ago, we didn't have these capabilities, but we understand where we are now and what we're able to do. So for maybe firms that are further ahead, what are some common pain points once you've captured that conversation? What can't we do yet? Is it data silos, lack of actionable insight? What are you seeing there?
Yeah, so I would say like the people who are really pushing the, like the front edge, if you will, they're able to get, as we talked about, draft plans. Even with some broker dealers, we can actually now even open accounts for them. So we can fill out that account and kind of drive that system. But I would say there's still a lot of systems more in the back office that are still taking manual data. So this dream that we have of there's two parts for us. One is like once the data is in the system, we should be able to put it anywhere, whether it's the planning system or, creating accounts, creating policies. So there's still a lot of backend systems to integrate with, frankly. Like we've been working through the ones that are most used, just because that's where a lot of time goes, but there's more and more we can do there. And then the other one is, and people will see this happen fairly quickly, is what we call insights across clients. And so, part of the dream of having all this data about your clients is you can start to kind of understand and query it, right? You can start to say, like, tell me all of my clients who maybe bought a house in the last few years and don't have life insurance, right? Like if you're selling life insurance, that's a huge deal. Like, do I reach out to those? How many people do we know who have kids or grandkids and no college savings plan going, right? Should I reach out to them and do it? Even just for interest things, right? For people who like to book events and work there, like how many of my clients like pickleball? How many of my clients golf? All of these things should actually be like readily accessible. And we're right on the cusp of being able to do that. And some of the firms are frankly doing really interesting things with like data warehouses and getting the data in there to query across. But that's still, I would say, like that's going to be a lot of the first part of next year is now that we've automated, and starting to do more and more for them, is also then like now that you have all this data, one of the great things with data is like new scenarios come out of it. And so how do we help you kind of like frankly connect better with your clients using that?
And just reflecting on this year in particular, obviously we're talking market outlooks here. So how has the macro environment, things like market volatility, regulatory change, staffing pressures and talent pressures at firms, shaped how firms view this kind of AI tool this year alone? And then we'll talk about the years beyond.
Yeah, so this year has been interesting because I think we're seeing two things, right? One is most people would agree that it's been a an unpredictable year, maybe. Like there's just a lot going on. Like it's gone very well in the markets over time, but like I think the path between January and today was nobody really thought. And so one of the big things we see is this is an important time for people to take care of their clients and reach out to clients and reach out to prospects. And they really want to be doing that in a personalized way, right? So I think as the markets, like hit whatever news up or down on like an AI bubble or, tariffs or anything else, we all typically get these notes from our advisory firms, right? Which are like, in troubled times, don't do anything. They're basically these generic messages, right? Which is like, don't go crazy and just keep going. What advisors really want to do is they want to start to personalize that outreach. They want to start to say, hey, Shannon, like you're actually in great shape because you're not exposed to these things. And maybe we even put something in place last year to make this better. Or like, hey, you said that you wanted to do a lot of ... high risky things, maybe internationally, like maybe now is a good time to rethink that and, make sure we have that. So that like the I would say kind of the craziness, if you will, in the markets has driven the need to get more and more personal with clients. And that's where a lot of the a lot of this kind of activity is happening. And then I think the other thing that's happening is whenever you have a lot of change like this going on, that's a very natural time for advisors to kind of grow and start to pull in more clients, right? Like they want to help them through these things. And so this ability, we see a lot of advisors who are growing their businesses very quickly. And for them, like everyone knows this, like it's hard to hire really good talent. And so what they want to do is take the people they have. They often have, a team of 1, 2, 3, 4, 5 people, and they want to kind of supercharge them. And so those I would say are the two biggest use cases we see this year, especially given the overall market. It's just all of the personalization that they want to have for the clients, and then just frankly, the ability to build velocity with the team they have.
So let's get under the hood then a little bit more and talk about what comes after the note taker. Obviously, Zosk especially has expanded far beyond that with some incredible capabilities. So beyond just simply capturing conversation, how can AI use the content of these advisor-client discussions to automate end-to-end processes? What are you seeing there? What's the roadmap?
Yeah, so we this year, like our strategy is fairly straightforward. It's really to work with advisors, focus on them and see where they're spending their time in areas that they either don't want to or not adding a lot of unique value, right? So that started off, a lot of advisors spend a lot of time in meetings with clients. So that was a very natural place to start. Once we started connecting with these other systems, it was really helpful because we can now do things like we saw advisors spending a lot of time literally just replying to client emails. So every day they come in, a few, sometimes more than a few clients, especially on a busy market day, will email them with questions, whatever. Maybe they need money out for something, they have a question on something. And they would literally spend 1 to 2 hours, their team would just pulling data and trying to draft replies to those clients. And so it was not only spending a lot of time for them, but it was also frankly slowing down the reply. So we middle of this year launched what we call email replies. So essentially, like we can use the data from the conversations, data from previous emails, data from CRM and all this. And, if a client mails you and they're like, hey, I'm thinking of leasing a car, would that help me or not, or whatever else, like we can literally go to Listaplan, get tax data, understand their current taxable income and tell them exactly the impact that's going to have. So that's been a big one. Email replies. We have this general concept that we call forms. And so if you think of the industry, right, a lot of it, although it's moved from paper forms to digital forms, it's still a lot of just structured data, what we call that, right? It's just filling in more and more information. So that's the other big piece that we, rolled out this year, where we can now start to actually fill out forms and things for you. And that's really leading to what's coming next year. So like we have account opening, as I mentioned, with a few of the broker dealers. That list is going to grow very quickly. A lot of that's already in flight, along with the kind of largest custodians that you would think of. So account opening, and then with that, we'll start to see things like money movement, beneficiary changes, all of these, what we think of as actions that people are spending time on. And ideally what we want is the advisor and their team to really spend no more time outside of just scanning it and saying like, hey, Shannon, it was great meeting you. We're going to move this money, we're going to open this up, whatever, and change this beneficiary. They literally are just going to like click and check. So that will come very quickly. And the idea is also for the client experience to get a little bit more like it would naturally be, if they were frankly just dealing with a fully digital, like, kind of online custody experience, but with all of the help and trust that comes with an advisor. So that's the big piece. And that's already like, we're seeing that in flight. The next thing you're going to see along with that is we have all this data, so we can really start to help advisors and their teams with the next best action, right? So ideally, they're waking up in the morning and they're saying, hey, Shannon told you 2 months ago that she's going on vacation this week to Greece or whatever it is. why don't you shoot her a note? Or maybe she just got back, right? Or she's going to her friend's wedding. Why don't you send her a quick note? Like any of these types of things. And that'll handle personal. So things that maybe came up in discussion so that we know we want to follow up on. And, most advisors really love, frankly, and they want to be more kind of attached to their clients. They're busy. That'll handle financial things. So like, annuities maturing, other things that may happen, as well as kind of what we think of as things in the middle. So like, hey, this life event happened. So like, why don't you reach out to them about this product or have this discussion on whatever that is, right? Setting up their estate plan, updating their estate plan, whatever it is. And so that next best action will start to come. And ideally what we really want is the advisors to just frankly come in the morning with their teams and just say like, yes, nope, right? Like maybe this one I need to customize a bit because maybe I have a bit of context. Maybe assign this one to one of the paraplanners to look into it, whatever it is, and just have them spending as much time as they can with clients and really just remove, it's like over 50% of their time is spent on administrative, like what we think of as back office tasks. And, shrinking that is really, really impactful. So it's really just working down that list.
And it goes back to that time savings element, right? Of utilizing a solution like this. So you better not have any advisors calling up saying, I've saved 10 hours this week. How else should I be spending that time? You just said it, going deeper with their clients, personalizing, and then streamlining, those things that can be automated. So I'm glad you brought that up. But I want to ask about how firms should think about the practice growth angle, using conversational AI as a lever, not just for efficiency, for growth as we head into the new year.
Yeah, that's a really good question. So we really see three different patterns that I would say more forward people are using to grow using AI. One is exactly what you would think about, which is just like, I already have a lot of clients that, like, frankly, I'm probably even saying no to for the very experienced advisors, and they can just scale the number of households that they can kind of like serve with a high quality. So that one's straightforward. I think most people see that right away. Another big one we see is very often people have what they think of as kind of like tier 1, tier 2, tier 3 clients, or kind of like, platinum, gold, silver, whatever they want to call them. And it's really the top tier that is the largest, and that they have a very good kind of rhythm that they work with. But those other ones, they've often done some either planning with, retirement planning, something, right? Sometimes they'll do fee-based or anything to get going. And what we see is they're able to now use AI so that they can actually reach out to those people and have a good discussion and almost nurture them, and also frankly like get leads from there. And so what used to be, if I didn't know you very well, or maybe I'd done a few different things with you, it may take me 2 to 3 hours to prepare for a meeting, have a good discussion with you, and then follow up. Now people can do that in under an hour, right? They can prepare in 5 minutes to a half hour, 40-minute meeting, follow up in 5 minutes. And so they can actually start to work through these kind of like tier 2, tier 3 clients, which are often a great source of either leads and additional business directly, or sometimes they'll also have friends, right? Like, oh yeah, my friend's also having the same issue that I work with, whatever that is. And then the third one that we're seeing is people are also starting to use, an AI system like Zox with let's say, estate planning system like a trust and will or something like that, or a tax system. And what they're able to do is essentially start to offer more services to their clients that kind of go beyond AUM, right? Just the pure assets under management. So they're able to help them more. They get more revenue from it. And the great thing for them is the clients love it because they don't want to move around between a bunch of people and then also have to like repeat all the data, right? Like I talk to, I'll say my accountant, and I have to repeat things all the time that my advisor has told me. I want to make sure my advisor is like telling my accountant different things that they're doing. It's the same thing with the state attorneys and everything else. And so that third pattern we see is that people are starting to essentially use a few different AI systems, both because they can share data really easily and they allow you to do things in these areas that maybe were pretty hard before.
So obviously this all shows a lot of promise, but with all of that obviously comes risks. So want your thoughts around major risks or blind spots advisors should watch out for when deploying conversational AI like this. Are you running into questions around ethical concerns, data governance? What are you hearing there? Maybe quell some fears for us.
Yeah, we get, as you'd imagine, all the questions, and we're approved at frankly, some of the largest firms in the country, banks now, quite a lot of these. And I would say there's unfortunately, everyone wants to know what's the one question I have to ask to make sure it's safe. And it's not quite that simple yet. But the few things that we really tell people to look at, one is, look at where the data is and make sure you can control it. So if you're working with a client, and let's say you're using a system like Zox, you need to be able to delete the data. You need to make sure that if it's deleted, we don't have copies of it anywhere, any of that stuff. There are a set of essentially security just base requirements. I would say generally anybody who has products that focus on financial services are dealing with it, but you want to check. So things like a SOC 2, Type 2 are kind of the base level there. But you want to ask, right, like how is it secured? Who can even see my data, right? And that's a big piece. And then the other thing that you want to just understand is how is that managed, especially with all these integrations? Like what you don't want to do is have a situation where you connect an AI system, let's say to your CRM and your planning system and, you know, custodian system, and it's just making copies of data everywhere. Like that's horrible. It's just, you know, like the more data that's out there, frankly, the more what we call the surface area of risk is. And so you want to make sure that the systems are very thoughtful. And like, as an example, like we will query these systems and analyze the data and then not store it unless it's like going into a specific field in e-money or something like that. Like you don't really want to keep big copies of it. And so I would say those are the big three from kind of a data security side, is make sure you own the data, make sure that they're not doing things like training with the AI, you know what I mean? With the data, with AI, that's a big deal. And that you fully control it, know where your copies are. And then I would say on the client side, the big thing we would really recommend is like just have the discussion with your client, right? Say, hey, we're going to use AI systems. We fully control the data. Make sure you do. Anything you say, this is really here to help you and help me serve you better. And, you know, we will erase anything that we don't want a record of, right? And if you can do that, it's fairly easy, but we would really recommend people start doing that. And then for the firms that are using it a little bit more systematically, they are starting to put it in their paperwork, right? Just tell clients that essentially we will use systems like this for it. But I would say those are the big ones. Just make sure the data security, and like, I know this is hard. I grew up in tech for my whole life, so it's easy, but someone will tell you like a system is secure, and that's actually not, like, you do care that it's secure, but you're also like, what are you securing? What data do you have? And again, as the advisor, what control do you have? Because you frankly need to control all your information.
Yes, that is great advice. So thinking about that in a similar vein, then I want to talk about 2026 and beyond, and really the strategy and action that advisors can take to make this most useful to them. So if you were advising an REA or an advisory team today, what would you say they must have in place by really the end of this year to be ready for next year and beyond?
I would say, like, if someone is literally doing nothing today and they're just like, how do I get going? I would get a program in place and a system, you know, like a Zox that you can use for AI. Make it optional if you want. You don't have to force it on anyone, but you'll see most advisors will start to use it. And that'll do two things for you. You'll start to get comfortable with what can the technology do, what's most important for your firm or yourself. Like, just different people are in different situations and they care about different things. The other thing it'll start to do is actually capture the data you want. So for people, as an example, that have been using Zox all year, as we do these things, like start to let them query, like, you know, which of my customers, again, don't have like college savings plans for their kids, that data is getting captured. So even if you're just using it for note taking to start, all of the pieces are getting in place so that when you basically want to start doing more advanced things, it's there and ready for you. And then you'll just get used to it. Like we, you know, with some of our largest clients, we've deployed extremely large enterprises in literally like 6 weeks and less. They get a lot of usage, and then they start to say, okay, like, let's get more practice management baked in, right? Like, let's talk about specifically what data we want from each of these meetings. Now let's start to look at, you know, tuning our meeting preparation and starting to do things like, you know, the forms and making sure that all the follow-ups are there. All of that can happen incrementally. You don't have to chew it all off at once. It's really easy to just start and get going, but it involves making sure that you've kind of done your homework on whatever you're looking at doing, and that you have obviously a program. Like any, you know, in financial services, you essentially just always need like, what's our policy? Are we checking it? Have we vetted the system? And I would say if you can get that going, you can do it very quickly. It's much faster than something like a CRM or a planning system. And if you can get that going by the end of the year, you're well set up for 2026.
And you brought up an interesting point, because you mentioned like larger firms and those enterprise scale plays. So want to break this down a little bit. You know, for smaller firms, say that 500 million and below in AUM versus the larger firms, $1 billion plus. How should the strategy differ when leveraging these tools? Are there quick wins versus that enterprise scale play? And, you know, what about when it comes to broker dealers versus wirehouses versus RAs? How are you seeing them approach AI?
Yeah, so we see those differently. Like, in a good way, the general strategy is the same, but, you know, it's a little different. So the nice thing, if you're, you know, let's say at more of a solo or a small shop, like, you can just look at it, talk to people, make a decision and go, right? Like, that's super easy. And so I would just recommend doing that. With the larger RIAs, honestly, that's what we end up doing at the start anyways. They're just always like, where do we want the data? How do all of these things work? How do people have access? What are the policies? But at the end of the day, they're doing the same thing, which is like, let's just get up and running and in a secure way with the privacy and security we want. And then we can start to layer these things on. The wirehouses are a little bit more complicated because I think of two big factors. One is, they typically have their own internal systems for all of these things. They don't use, I would say, off-the-shelf products as much, like a financial, like a Right Capital or an Orion as much. They kind of have all of their own stuff. So a lot of those have been playing with a lot of the AI systems themselves, like Copilot. Microsoft's is probably the most common, and getting people used to that. Even that is helpful. It starts to get them used to it, starts to get them to answer the questions of like, how do we get going and how do we actually get AI through? Typically, once someone becomes comfortable with the Copilot, and then they look at something that's very focused, like SOX on that, it's kind of obvious the difference and all of that. But a lot of the core questions around where's the data, how is it secured, what is our policy, how do we talk to clients, it's the exact same. And so even starting there is very helpful for people.
So what excites you then most about the interplay of AI and advisor-client interactions? What's the moonshot here?
It's a super exciting area because I've worked in technology products my whole life. I've kind of been a builder. I'm a software engineer by training. And so for us, a lot of it is you're now building a product that frankly is automating and taking away the work that most advisors and teams hate, right? They're like, I'd rather be out talking to clients. I'd rather be doing events with clients. And then a lot of them are just overworked. They're like, I don't want to work till 12 or 11 p.m. on a Thursday, try to get all my stuff done. Like I can now just be done and spend time with the family. So that alone is awesome. And frankly, that's what gets, the whole organization for us up and running every day. But the big pieces for us is we really see the ability for people. Like there's a huge number of people, in the US and around the world who just do not have any financial planning, help, advice, interactions. And part of that is the structure is hard now because it's hard to scale with all these people. And it's also just a little daunting for some of them to get in. And so I think what we're excited about is the more and more we can do for the advisors and kind of like help what we call operationalize their practice and automate it, the more people they can serve. And frankly, like I think everyone knows there's a lack of advisors, in the industry, especially for like the market that's growing. More and more people in the US are becoming, wealthy in that way, and the wealth is growing. And there's just more and more services needed. And so our real goal is just to help accelerate that and help advisors grow their business as much as they can. And frankly, spend time with their clients, which is I would say why 90% plus of advisors started doing this in the first place.
Well, maybe I'm reaching here a little bit, but I'm curious your thoughts. But do you think solutions like this will become a true competitive differentiator? Will we see things like new revenue models? Will advisory firms reorganize around it? What are your thoughts?
Yeah, the answer is yes. Like you're going to. In fact, we're already seeing that, right? Just imagine this, right? If you're running a firm and you have people coming into your office regularly, like I'll call them prospects, right? That you've maybe talked with once or twice, or maybe they're leads from a system, and you can talk with them, have a very both kind of effective but kind of personal conversation about what their goals are and everything else. And then they walk out of that meeting, and within 10 minutes, they have a personalized plan sent to them with an email that says, hey, we really appreciate talking to you. Here's what we heard, and here's what we're going to do. And then you can do that reliably. Like your business is just going to grow quicker than other people's, right? Other people take 4 days, sometimes a week or two to get that back. And at that point, it's just gone. So that's a very simple example, but that's already happening, right? And so what'll happen is a lot of people look at it as time saving for themselves. I think the big thing here, and we're all going to be talking about this at the end of next year, the year after, is the client experience gets way better. And that's very hard to, it's hard to beat that, frankly. It's really hard because that's what clients are looking for. And I think just as you see these new technologies come in, like we kind of joke, I'll just say I'm a little farther in my career. So I remember the initial internet boom and bubble and bust. At that point at the start, everyone took a pet store, put it online and started selling pet food, right? Or whatever, in the same way that they would in the store, and it would just deliver. So it's kind of like the in-person analog of that just brought online. And then, you fast forward 10 years and you have Airbnb, you have Uber, you have Instagram, like the whole world is shift. And so you're going to see the exact same thing in financial services come through, right? Like the person still matters a lot. And in a way, a lot of these technologies have allowed us to scale the best people. But just the way that you operate is going to totally change, in the same way that it would be very hard for most advisors to operate without software today. If we just said, hey, give us all your computers back, don't do anything, like everything's back to pen and paper, you just can't scale with that anymore. And it's going to be like that, again. Yeah, so it's exciting for us, and there's a lot going on.
Absolutely. And I know we have just a minute here. We did have an audience question. I just wanted to put you in the hot seat here for a second.
Sure.
You'd be able to answer this one, but the question was, what is the process of transitioning current clients into your system? Maybe you can kind of just give the high level.
Yeah, so it's super easy. We've done a lot of work to do what we call bootstrapping to make sure it works. So if you have a CRM today, you can just connect the CRM. It's one click, and any data in that will start to do things like prep, and then also like we can use that data to help do things like, again, fill out planning systems and all that. And if you don't have a CRM system or you've never met with the client, you literally have one conversation with them, and then we capture and give you notes and all that, but we also structure all that data so it can go into the CRM and start to fill in. So it's one of the reasons that people can get going so quickly is there's no migration. There's no like movement in those things. You literally just start and connect the other systems. And basically the system will get smarter the more you use it.
Amazing. I think that is a great ending point. So Mark, just final thoughts here before we sign off for our final summit of the year. Just tell folks where they can learn more about Zox if they're interested.
Yeah, so Zox, zocks.io or zocks.com. We have videos up there. Grab a demo with us. We're happy to give you a 5 or 10-minute demo, even if you just want to understand how it works and what's there. It's super easy. You can even start trials. There's no cost to any of that. We'd love to chat with you. We're happy to kind of share best practices and what we've seen. We've now, I think in the last year and a half, brought on a little over 3,000 firms using the software. So a lot of experience, and happy to share that with everyone too.
Fantastic. Well, Mark, thank you as always. I know I always learn something from chatting with you, so appreciate the conversation today. And as we conclude this Market Outlook Summit, I just want to express my deepest gratitude to our incredible panelists and sponsors, Artha, Trustable, and Zox, for their invaluable contributions. And just your engagement and insights have really made this event a resounding success. And just a few closing reminders before you log off. Again, the summit has been recorded and will be available for on-demand viewing. You can access it using that same URL you're using today. And for those of you seeking CE credits, all the detailed submission instructions are available in that resource list widget I mentioned. And upon exiting the event, a short survey will appear in your browser. And we really do value your feedback as it helps us tailor future events to your interests and needs. So if you wouldn't mind filling that out. And again, thank you to our audience for being part of the summit. We look forward to your continued participation in 2026. And on behalf of wealthmanagement.com, have a great rest of your day. Thanks for tuning in.
Thanks, everyone.